Okay, in this video, bank reconciliation. And what we're doing in this in this video is we're really trying to figure out how much cash we have available to us. Like if your boss came to you and said, "Hey, we're thinking about acquiring this new piece of machinery and it's pretty expensive and we need to know what our current cash availability is." Like where do you go look for that? It would seem like, man, the most obvious place would be I'm going to go to my books and records and I'm going to look at cash, right? And I could have, all sorts of debits of various cash transactions, and then I can have some credit transactions. I could come to the conclusion that I've got 30,000 in positive increases to cash and I've got 10,000 uses of cash, and therefore my cash balance should be 20,000. Okay. However, it could be the case that your bank is making collections for you, right? So if you're a fairly sophisticated company and you're selling on account, maybe you have sales on accounts receivable, right? And say you have a $10,000 account receivable from some client and you booked revenue or sales. It could be the case that your client sends you the money directly to your bank. And so you're not aware of the instances when your bank collects cash for you on your behalf. And so there could be $10,000 sitting in your bank that you're not aware of that currently isn't recorded in your books and records. So what we're trying to say is there are things that are happening within your bank that don't make their way to their books simultaneously. If your bank is collecting cash for you, that's something that you're not going to be aware of unless you go to your bank account. Your bank, unfortunately, is going to be charging you fees as well, like service charges. And if you're ordering checks, they're going to charge you for that. It could be the case that you wrote checks, or sorry, individuals wrote you checks and those checks bounced, right? So when your bank tried to collect on certain checks, say somebody sent you a check for 10,000, you recorded that 10,000 as cash. When you deposit it, maybe it bounced. Maybe your customer didn't have that money in their account, and therefore you don't really have that. Okay, so there's all sorts of things that are happening at your bank that we're not aware of. And so the cash account isn't the best place to go. And then likewise, right, we can go to our bank statement and we can be like, okay, well, we'll just go to the bank statement and we'll look at what the bank statement says. And your bank statement could have an available balance of 35,000. And you could say, well, that clearly is probably what our cash availability is because we have 35,000 in cash. But in reality, maybe that's not the case, right? Because there could be instances when we as a company, we wrote a particular client a check for, or maybe we wrote a vendor a check, and the vendor hasn't taken the check that we wrote to our bank to cash that yet. And so we refer to those as outstanding checks, right? There are instances when we lowered our cash account, right? If I wrote a check for 5,000, I'm basically saying, hey, you know what? I'm going to debit that accounts payable 5,000 and I'm going to credit cash 5,000. Okay. That was this check right here. However, the customer hasn't gone to the bank and cashed the check. So the 35,000 that we see in our bank statement, it's really 30,000 because I have this $5,000 check that has yet to be cashed. So the books and records aren't accurate and the bank statement's not accurate for all sorts of other things in addition just to outstanding checks. So we have to reconcile. Okay. And that's what this lecture is getting at. How do we do that? Bank reconciliation. So I don't know why they do this, but the previous slides, that's a nice picture of a bank statement. Okay. It's a nice picture of a check, nice picture of a deposit. This is a good slide, right? So there's all sorts of things that your bank is going to do for us. And these are the types of things that we have to now account for when we are doing our bank reconciliation. Okay. So, I want to get to this is the slide that I really wanted to focus on. Okay. So when I am doing a bank reconciliation and I start with the books and records, and books and records meaning the cash T account, right? The things, whatever my T account is for cash, the ending balance, this 10,000, what we need to do is we need to add any interest from the bank statement, right? So if we open up the bank statement and we look at the bank statement, we're going to have interest that we may have earned, right? So if I have a lot of cash in the bank is going to allow us to earn interest. In addition, there could be insufficient checks where we were just talking about this. When we recorded the receipt of a check, we treated it as a debit to cash. And then we took our check to the bank and we deposited it. And then the bank went to our customer's bank to pull that money out of our customer's account. And if the customer doesn't actually have the money, we call that an insufficient funds check, right? So we initially recorded a $5,000 increase to cash, and our bank is saying, hey, listen, you can't do that because they didn't have the cash. So we now have to lower our cash. And then there could be instances when we accidentally make a mistake in our books and records, and we realize we made a mistake when we're looking at our bank statement. And it could be the case where we recorded a $50 check but in our bank account, so we said, hey, let's credit cash 50, but when we wrote the check, we wrote it for 500, right? So the bank deducted 500, but we only deducted 50 from our books and records. That's an error in our records, and therefore we need to subtract more. We need to subtract another 450 from our books and records. Okay, so we're going to go through this in an example, but these three things are what we need to do to the books and records in order to reconcile or come up with a number for the books and records. On the other hand, for the bank statement, right, I'm going to have a bank statement and it's going to have all of this information in it. But in addition, I have to adjust the bank statement for these instances. Okay. So deposits in transit, that's going to be an instance where we deposit, like if I take $1 million check to my bank and I deposit it in the bank and I tell the bank right then and there, hey, I want to take out $1 million in cash, right? The bank's going to be like, okay, slow down, relax. Okay, this check, $1 million, we don't even know who this person is. We need to go see if that $1 million exists. Okay, so you're not going to get the $1 million until we go verify that the individual who wrote you that check has $1 million in their account. Right? That is a deposit in transit. It's like you making the deposit at the bank, but the bank's saying, okay, we're not giving you access to that until we make sure that you actually have that cash or you're going to get that cash. And then, like we were previously talking about, if I wrote a check to somebody and they just haven't gotten to the bank yet, that is an outstanding check. And I would have to subtract all of those outstanding checks that I know that I've written, but they're not showing up in the bank statements yet. And then again, I have to add or subtract corrections of bank errors. That is rarely going to happen, but it could happen. The bank could make a mistake. This is a great slide. I would just be very familiar with this slide when you're working through the rest of this portion of the chapter. And I think in fact, this is a good slide as well, right? Again, we're dealing with the bank statement, cash balance per the bank. We're adding deposits in transit. We are subtracting outstanding checks. And then rarely do we make changes related to bank errors. But then we have this adjusted cash balance. And the important thing to remember is that is going to equal, okay? That is going to equal the cash that we have available to us from the book reconciliation. And remember, the book reconciliation starts with cash from the T account. Then we're going to add collections that the bank made on our behalf and any interest that we earned. Then we're going to subtract fees that the bank is charging us, and then any checks that we deposited that weren't actually good. And then if we made errors, right, that we recognize we made when we're looking at the bank statement, that happens occasionally, we would add or subtract those. But the point that we're making is, regardless of whether you do a cash reconciliation using the bank statement or a cash reconciliation using our books and records or the T account, either one is going to give us the same answer. And so we're going to do both to make sure that we didn't make any mistakes doing one or the other. And again, like I said, I want to say that rather than walking through these PowerPoint slides, it's probably better for me to just pull up a question from the homework.